Right, welcome back. You're watching The China Show. Let's pose this question that a lot of cross-asset managers are thinking about right now. To what extent should we be exposed to the dollar? How do we lean into the sort of de-dollarization theme? Let's take a step back and have a look at the dollar, specifically this push to devalue maybe the currency coming from within the Trump team. Stephen Marin is the chairman of the Council of Economic Advisors and the brain behind the so-called Mar-a-Lago Accord. And in this paper that he published last year, mentioned the overvaluation of the U.S. dollar 10 times. But our Bloomberg opinion columnist, Shuli Ren, says Mira needs to be careful what he wishes for. She joins us now. And what is he wishing for that he doesn't know he's wishing for?
Well, what they are saying is really spooky. In that paper, he basically said that Americans don't want to consume so much stuff. It's because of the dollar's reserve currency that they have to consume so that foreigners can get hold of dollar. And it just sounds very spooky, right? And then his solution is that the U.S. trading partners have to collectively devalue the dollar. And because the reserve bankers have to sell the dollar to devalue, right? They should also do a debt swap. And when we hear about debt swap, it's really like when we think about debt swap, it's China local government bonds or China Evergrande Group. It just sounds terrible, right? So, and especially like since the pandemic, the Asian nations, the export-oriented Asian nations, they have run huge trade surplus with the U.S. because the Americans bought a lot of stuff during pandemic, right? And all these exporters, they have been parking their money offshore. We know like Hong Kong's dollar deposits have been soaring, right? Like the Chinese exporters, they are not repatriating money back to mainland China. They're leaving all this money offshore because the US dollar earns 4%, right? The Chinese yuan has been weakening. And the same story goes with the Korean won, the Taiwanese dollar. And if just small mom and pop exporters, they feel like, okay, the dollar has peaked, right? The first thing they will do is to come out of their dollar deposits and repatriate into their local currencies. And that's very dangerous. And it's nothing that the macroeconomists can control.
Is there a way then for these exporters to basically unwind these sort of naked long dollar positions now in a timely or at least in a orderly manner?
I think, to China's credit, the PBOC has been keeping the Chinese yuan fix fairly stable. So that kind of de-incentivizes the Chinese exporters from repatriating. But still, I think ultimately it comes down to the White House. They need to stop talking like this, right? They need to stop talking about like American consumers being duped by foreigners, stuff like that. The rhetoric has to change. Consumers being duped by foreigners, stuff like that. The rhetoric has to change. Or like American consumers being duped by foreigners, stuff like that. The rhetoric has to change. About like American consumers being duped by foreigners, stuff like that. The rhetoric has to change. About like American consumers being duped by foreigners, stuff like that. The rhetoric has to change.
Are we likely to see more episodes of dislocation in currency markets like we did with Taiwan, for example? And we're trying to figure out who is intervening, or if they're actually allowing the strength to happen. And I wonder, intervention risk, how pronounced is that in currency markets these days?
I think there's quite a bit. I mean, we have seen a lot of that with Hong Kong, right? Last week, the Hong Kong 1 month HIBOR went from almost 4% to 1.9%. The HKMA was actively intervening to keep the currency peg. But I think ultimately we know a lot of Asian currencies have been undervalued. The Korean won, the Taiwanese dollar, and to some extent the Indonesian rupiah, right? And then these markets are thinly traded. So any rumors can just suddenly see a melt off of a local Asian currency.
Shuli Ren, thank you, a Bloomberg opinion columnist, joining us now. Some other corporate reads that we're checking for you today. Saudi Aramco reported a drop in first quarter profit as lower crude prices pressured its finances. Net income fell 4.6% on year, while free cash flow again failed to cover the dividend despite the total payout being lower. It's the latest sign of pressure on Aramco's balance sheet, even after it decided to cut its dividend for the year by about a third. CATL has started taking orders for its Hong Kong stock offering, which looks set to be the world's biggest listing this year. The Chinese EV battery giant is offering shares at a maximum price of 263 Hong Kong dollars as it seeks to raise around 5.3 billion US dollars. Meanwhile, Bloomberg has learned that CATL is planning to limit US participation to investors with offshore accounts, excluding domestic mutual funds. We got plenty more ahead. This is Bloomberg.